Welcome back, and joining us now on the show is Sandeep Bhan. He is CEO at Sime Darby Oils Trading. Sandeep, hi, thank you so much for joining us. It's a period when we are looking at most of the edible oil prices declining. Soybean is trading at a 3-year lows. We've been looking at 9 weeks of constant losses on that. And the palm oil prices, while they did touch 4,000 on the higher side, but they have continued to slip on that one as well in the last week or so. What's your sense now on the kind of demand that there is and the prices?
See, Manisha, it's very rare that happens in the market. Today, palm oil is the most expensive oil also, and palm oil is the most cheapest oil also. What I mean by that is, if we see on the CNF basis, the price of crude palm oil as at Friday's closing was USD 930 per metric ton, CNF West Coast of India. And soybean oil, sunflower oil were 910, and refined palm oil was 890. So that way, palm is cheapest also, and palm is the most expensive oil also. Why is crude palm oil expensive? Is mainly because of the tightness in the nearby months, which was a seasonal phenomenon, nothing new in it, and it was on the expected lines. That's why the crude palm oil is holding pretty well, because it's required both by the destinations as well as the refiners in Malaysia and Indonesia. Because of limited supply, more demand locally in origin, CPO prices remain high. But as we process the CPO into refined products are freely available, and that's why they are at the most cheapest among all the oils on CNF basis. In terms of soybean oil and sunflower oil, soybean oil, Latin American crop was expected to be a very huge crop of somewhere around 200 million tons, because of which then there was this aggressive selling to catch up the markets. So that's how we saw an aggressive sell-off in soybean oil, which continues in India till today.
Absolutely. Sandeep, when you look at the Indian imports itself, well, the palm oil imports for the month of January have seen a 12% of a decline, which is at a 3-month lows really. How is Feb looking right now? What would you say about the rest of this quarter?
We are working on the numbers like it will be somewhere around between 550 to 600,000 tons in next couple of months, because India has bought a lot of cheap soybean oil for February shipment, March shipment. That is at the cost of palm oil's demand. So palm oil will see a drop in arrivals in India in coming next 2 to 3 months. And we should see it picking up back from April onwards when the seasonal production picks up.
You talked about the rival oils, Sandeep, and well, yes, it's a period that we haven't seen in a very, very long time, with the kind of premium that we've seen palm oil command over soy, sunflower for that matter as well, the highest actually in perhaps a year or so. Do you see that also changing back to April onwards?
Yeah, definitely that scenario has to change. I mean, palm gave away its big part of its demand to soft oil because of the price competitiveness. But once the production picks up, which is expected to start from second half March onwards, and should see April pick up sharply, picking up the production, and that palm will need back its demand. That's where palm will have to adjust the prices so that it gets back the demand which was taken by soft oils.
Sandeep, when you look at the tariff duty, and I mean, this is something that there has been a lot of debate about on how it should be dynamic. It can't be so low, and the kind of imports that India has seen, this being an election year and all of that. But how long do you see the duty structure to continue like that? And the point that you were making about palm and refined palmolene as well, that is something as a duty difference which the street has been asking for. How would you look at the overall scenario?
See, at this moment, I see that Indian refiners are enjoying quite good margin in soybean oil and sunflower oil. I think that should continue there as long as they have very good margins, and prices are also low, which benefits the consumers also. There's no reason why to step into palm at this moment when palm market is extremely tight on CPO, and you increase duty will make it more expensive.
Sandeep, how would you also look at the Indian demand going forward? There have been some very exorbitant numbers put out in the next 3 or 5 years in sense of estimates. What's your own sense?
See, 9 million ton bare minimum is year on year, India will continue. It's only whether 9 will go to 10, which unlikely now this year because we gave up a lot of demand to soybean, our rival oils. But next year, 2025, 2026, we should see palm going back to 9 to 10 million tons imports into India.
A very quick final question, and what's your sense on prices going forward?
It's a very challenging question in these markets today. We see, if we talk about palm, we have seen palm has been moving in the range of 3,600 to 4,000. When it goes to 36, 3,800, you see a good demand, it bounces back to 4,000. At 4,000, it doesn't sustain because of the pressure of the soft oil. So it's caught in a very range-bound market of 3,600 to 4,000.
And that's perhaps a range that we will continue to see for some time to come. Sandeep, as always, thank you so much for joining us. So the Indian demand for edible oil continues to gain, especially as the prices have been keeping on the lower side. But with that, it's time for a very short break. We come back and we'll put full focus to equity markets yet again.